So hello and good afternoon to everybody to our next and let's say April New Economy Shortcut session. And we are very happy to have two excellent scholars to contribute or to lead this session. And those who follow regularly will have remarked that this is the same setting as and the same people, the same panelists as last year, exactly 1 year ago, I think, more or less, when Martin Wolf presented his book, his new excellent new book at the time. And Martin Hellwig has commented on it, and this time it's will be the other way around. Martin Hellwig has updated the very famous and big book about banking and the banking crisis that he and Admati published 10 years ago, more than 10 years ago, 11 years ago, 2013 in the first edition. That was the first big let's say, work on what the big financial crisis has learned us and whether there needs, which big reforms banking needs. And you both have now come back on this topic after 10 years and asked the question, what has been done in between? Are reforms enough? Or why are we still having regular banking crises like 1 year ago with Credit Suisse, with Californian banks and others, and constantly the sentiment of having instability in the system? So you have reworked and you have updated your book and now published it, and you will talk about this to start with. And Martin, you can go ahead in a second, and then Martin Wolf will comment on it, and we will have a discussion between the two of you. And we have a lot of very high-level people in the audience, including your co-author, Martin. So we will very certainly have a good discussion afterwards, and we'll open the discussion. But first of all, please tell us about what you think about banking 10 years after your first book on this topic, the big one.
Okay, let me begin by thanking the organizers, and in particular Thomas Fricke, for providing the opportunity for this discussion. Thank you also to Martin Wolf for being kind enough to act as a discussant. So the occasion is a new and expanded edition of the book, The Banker's New Clothes. Here it is. The title picture is the same, except the ties are now red. No woman and no African-American has been added to the bankers. The draftsman who designed this cover said he had worked in a bank and this was the way it was. No women and no African-Americans. It's again written with Anat Admati. The text is the same as in 2013, plus 4 new chapters, entitled Too Fragile Still, Bailouts and Central Banks, Bailouts Forever and Above the Law, ? If I had to do this again today, it would be an exclamation mark, I suppose. Now, the original book, which is the first 13 chapters, by the way, this adds about 50% of the material of the original book. The original book had the objective to provide an analysis of banking and bank history that would be accessible to general readers, beginning with a simple discussion of the bank balance sheet, what's on the asset side, what's on the liability side, the role of bank equity as a means of bank funding, a means of loss absorptions, and a source of incentives. The title of the book, The Banker's New Clothes, referred to the fact that many of the arguments in policy discussion have as much substance as the emperor's new clothes in Andersen's Tale. A typical example, in 2010, the British Bankers Association wrote the Basel Agreement will require British banks to have 700 billion more in equity, and that's 700 billion less in lending. Clearly, they have not understood or chosen not to understand that equity is a means of funding and lending is an investment. And that with additional funding, you can do more investments, but they are not competing. Maybe they had also confused equity with cash reserves. That's the very basic level which we're talking about the banker's new clothes. Of course, our pointing to the flaws has not made the lobbyists drop them. They're as prevalent as ever in the current US debate on the so-called Basel endgame, and they were also in the European discussion about the completion of Basel III. The main reason for discussing equity and equity regulation is that there are serious biases in bankers' choices of funding. The standard phrase is, equity is costly. Well, it may be costly to the bank's shareholders because some of the benefits accrue to the creditors because bankruptcy becomes less likely. It may also be costly to the bank's managers who find bonuses harder to come by. But when you are borrowing at the level of 94% of your assets, or as was the case before the crisis, 98% of your assets, maybe that's the very problem you want to solve. And everybody who's forced to do something he doesn't want to do will say that regulation is costly. So the question is, why are they so vehement about it? I listed the titles of the new chapters: Bailouts Forever. And around the mid-2010s, there was a message, too big to fail is over. We can resolve banks without damage to the rest of the economy. That's just a myth. Too big to fail is still as much a problem as it was 10 years ago. Credit Suisse has provided us with an example. And all the people who say the Swiss government should have just put them into a resolution regime or bankruptcy regime and wound them down, in principle, I'd like to agree with them. But I would not like to live through the financial crisis that would follow. There are three main unresolved issues. The first one concerns cross-border coordination. These institutions work in multiple jurisdictions and are important in multiple jurisdictions. And there is no way to coordinate activities of supervisors or receivers in such a way that integrated processes across these jurisdictions can be maintained. In the UK, the basic experience was when Lehman Brothers went bankrupt, Lehman London had no cash because cash had gone to New York the previous Friday and had not come back. How do you maintain operations if you don't have any cash? Provision of liquidity in such a procedure is a major problem as well. The Swiss National Bank did not want to provide funding for Credit Suisse, additional funding for Credit Suisse, unless it was guaranteed by the government. The European law on all of this, the so-called Bank Recovery and Resolution Directive, doesn't even have the word liquidity in it, let alone a rule that addresses the problem. In the case of Banco Popular Español, they had to have an emergency sale, a fire sale to Santander, because liquidity was disappearing and there was no way to keep the bank going. One needs resources, funds, and people to run the bank in such a procedure. The authorities don't have that, and they have no provisions for how to organize that. This is why the Swiss were very happy to have UBS deal with Credit Suisse. I wonder what they're going to do when UBS gets into trouble. Another aspect of this is the politics of it. The coordination problems might be solved if there was a single authority. But there is no way to get the Americans, anybody else, to agree on having a single authority in this. Maybe even difficult to get the European authorities inside the euro area to agree on how to deal with this. Some member states certainly don't even want to deal with the problem that way. This is why the problems with the Italian banks dragged on for so long. And the governments are right to be afraid of that, because if they actually do step in, and if they actually do make creditors bear losses, they may lose the next election. This is what happened to the Italian government in 2018 after winding down the Venetian banks. The German government, of course, has made sure that the Landesbanken would not be wound down. So, too big to fail being over is a fairy tale which nobody should believe at this point. Too fragile still. We actually started writing this new edition in September 22 on the assessment that the public discussion about bank regulation had taken a few, and to some extent the regulation itself had taken a few steps backward. We were due to deliver the manuscript by March 15th. So, and even though we had apprehensions about Credit Suisse before, we were surprised at the speed with which the crisis came, and then changed and revised until late May. Some economists say, well, but this was just a liquidity problem. You can't do anything against runs. Runs are endemic. I think that's a way of copping out of dealing with the actual problems. Silicon Valley Bank had been insolvent at least since September 22. In the years of close to zero money market interest rates, they had more than tripled the deposits that they had taken in. And because there weren't so many loans to be made, they had put a lot of the funds into quote unquote safe securities, government bonds and guaranteed mortgage-backed securities. The problem was that these securities did not have any default risk. But when interest rates shot up in 2022, they lost in market value. At the same time, some of the people who thought, why bother with the money market if it's easier to go to a deposit, left again for the money market where interest rates had risen. So they had to service those people who wanted to leave. Some of that came through cash, some of it came through borrowing, some of it came through selling securities. And the announcement of March 8th of last year made it clear to everybody that they'd reached the point where all these securities would have to be written down and the bank would have to be closed shortly. So this wasn't your standard. People run because they expect others to run. people run because they know that next week the bank will no longer be there, which is quite different. And the challenge is to deal with banks where we know that next week they will no longer be there. For Credit Suisse, the story is similar and lengthier. It involves incompetence of management, unwillingness or inability of management to control risks, imaginative valuations, and the development of serious mistrust in the solvency of the bank and the evaluations that they publish. Would equity have made a difference? I've heard quite often, if there's a run, equity doesn't make a difference. Well, with Silicon Valley Bank, a stricter equity requirement would have significantly restrained this completely unproductive growth in 20 and 21. With stricter equity requirements, also the supervisors would have been forced to step in much earlier, at a time when the bank was still solvent and just about approaching insolvency. And it's the same story for Credit Suisse. Except Swiss law does not even give the supervisor the power to step in before they see a violation of equity or liquidity requirements. Where are we today? Well, Silicon Valley Bank was not solitary. It had a Signature and First Republic to accompany them. But altogether, there were many more regional banks in the US doing basically the same kind of strategy as SVB. They have been helped by liquidity support from the Fed. But if you get this liquidity support from the Fed at 5%, and you still earn 1% or 1.5% on those securities that you acquired in 20 and 21, you're not really safe. This is very much reminiscent of the story of the American savings and loans institutions in the early 80s. They were sitting on portfolios of long-term mortgages, 6% fixed for 40 years from the 60s, what market rates were at 16%. So deregulation of deposit rates meant they were liquid, but they were insolvent. And the 80s provide a not very appetizing way to play out that scenario. We should brace ourselves for seeing a repetition. European banks have been less exposed to this sort of strategy and this sort of risk, but also they're much less transparent. So I don't really know what to expect. They're also much less profitable because of more intense competition than in the US. I mentioned the final chapter above the law question. That chapter deals with things like the LIBOR fraud, the cum-ex tax fraud. For some reason, I had not yet really understood the HSBC money laundering affair, which is relevant here. Well, HSBC was the money laundering provided by HSBC was an integral part of the business model of the Mexican drug cartel of El Chapo. And when the US authorities wanted to go after HSBC in a criminal procedure, the UK Chancellor of the Exchequer, Mr. Osborne, wrote a letter to Bernanke and Geithner saying, if you do this, you are going to have another global financial crisis. So those two prevailed on the Department of Justice not to proceed with criminal proceedings, They had a so-called deferred prosecution agreement in which HSBC agreed to everything that was claimed and got off with a 1.9 billion penalty. That's about 5 weeks worth of profits. I've heard it on many occasions from officials that all these sanctions really pose a very heavy risk to financial stability. I've never heard that any of the misdeeds that these sanctions are supposed to deal with pose a risk to financial stability. So I'm afraid we have not made much progress since 2008.
Thank you very much, Martin. I hand over to Martin Wolf, please. You're muted.
Yes, and can you hear me now?
Yes.
Good. Okay. Let me just. Okay, I have a few slides. Let me go back to. I don't know where I ended up here. I'm sorry. This makes no sense. Let me just just stop a moment. I better get back to the my slide. Okay. That should work. It's oh no, I can't see this. Okay, sorry, this is not what normally happens. Okay. Now it works. Yes. Okay. Sorry. I'm going to start with a little quote, which is very famous, which is perhaps eliminates what's being said here. And the very famous quote is, if you owe the bank $100, you have a problem. If you owe the bank 100 million, it has a problem. But if the bank owes the public $1 trillion, it's the government that has the problem. And that is basically where we are. This is the core problem which this book has addressed, and in its revised version has done even more clearly than before. And I think Martin has provided a very good overview. I'm not going to comment in my short remarks on the book because I think it is the best analysis by far of the problem with banking, and I am going to focus instead on a sort of simple-minded view of what the problem is and why we don't seem to be able to solve it. Instead of sort of focusing on the specifics of the book, with which I very, very strongly agree, that in 10 minutes I can't add very much. So let's start off. I'm going to start with just going back to what is the core problem with banking and what are possible solutions to the problem. And there seem to me two sort of classes of relatively serious solutions out there, neither of which have come anywhere close to being done. One is the Admati Hellwig solution, which is treat these as normal private companies with a proper degree of capitalization and strip the implicit subsidies from the state away from them. And the other are variants of the let's make the most liquid liabilities secure answers. And the Chicago plan is the most extreme. And there's a rather moderate Mervyn King alternative. And I just want to discuss that as an alternative possible way of going about handling these problems. And basically the question is, will either be adopted? And the answer, I'm afraid, is no, because what we've created is an unbelievably successful racket. And essentially what banks argue is that if we don't allow the racket to continue, the economy will collapse. And that it's been very successfully argued, and nothing has changed in this core political economy reality. Banks are deemed too important to fail, and this is essentially because they perform two quite obviously essential functions. They are the dominant sources of credit in most modern economies, and of course, they're also the dominant suppliers of money in most economies. In other words, their liabilities are the principal form of money. And I define money for this purpose as simply the most liquid asset held by the public, and as well, and for the same, essentially the same reason, it's just the other side of the same story, the most important means of payment. And when things are uncertain and insecure, it becomes particularly important that this be safe. So these private profit-seeking institutions provide what is pretty clearly a public good. And crucially, I think the safety of money becomes most important to the public at times of financial crisis, because that's when they say, well, if everything goes completely pear-shaped, what am I going to buy my groceries with? And that's a pretty powerful question, which quite a lot of people were asking the United States in 2008. But of course, that's precisely when money is likely to appear least safe to the public, and you're going to get a crisis. So if confidence in bank money comes in question, there are likely to be runs on some institutions whose liabilities this money is. There will be banks will be unable to resist those runs and will collapse. This will cause an economic crisis, creating still more mayhem for banks and so the economy. And awareness of fear of this has led governments over time to create central banks, deposit insurance, and a whole host of formal and informal backstops to underpin liquidity and the appearance of solvency. And Martin is right, is one of them is they don't actually take them to law when they're being very, very naughty, because they think that will cause all sorts of problems for them. So the aim is to make banks safe, quote unquote, and the result is to allow bankers to take greater risk, since increasingly the state is the ultimate risk bearer of last resort or first resort in the system. It is the institution that says these highly liquid, safe liabilities of banks will remain safe, whatever happens to the asset side of the banks. And the solution to that problem is to create ever more complicated regulations, which bankers are spectacularly good at gaming. My friend Andy Haldane, who used to write a lot about this when he was at the bank, at the Bank of England, used to say this was a Red Queen race and we weren't winning. So what are the possible solutions? We have this inherently fragile business whose main liabilities are money, which the public and so the politicians are not prepared to allow to fail. As we saw last year with Silicon Valley Bank, which Martin referred to, this is even true when depositors are immensely wealthy and clearly able to bear the losses. So what is to be done? Well, solution A is Admati Hellwig, and sort of beautiful corporate finance solution, force banks to finance far more by shareholders' capital than management says they need. And management says that very, very loudly indeed. Crucially, remember that the optimal amount of equity for bankers is zero. Then all the risk in the bank is borne by taxpayers, and essentially all the return on the risk they take goes to bankers because there are no private shareholders. Now, this may sound like a joke, but as Martin pointed out, before the global financial crisis, the leverage ratio of many big banks, properly measured, was 50-1. There was essentially no shareholders' equity in the system at all, which gave, of course, spectacular returns on equity from which bankers could be paid until it all went pear-shaped and they went home with their money anyway. The problem, of course, with this solution is that bankers win the political war by insisting successfully that being financed by equity to a reasonable degree, 3-1, according to Admati Hellwig, will destroy the economy because all sorts of good things won't happen. So the banks basically are in the market in life and wards of the state in death. And this is a very, very nice game. Now, the alternative solutions that are being proposed, which I think are at least moderately interesting, as I said, are the Chicago Plan and the proposals put forward by Mervyn King. The idea is to make liquid monetary liabilities safe by backing them with unimpeachably safe liquid assets, essentially to change the asset side of the banking system with respect to liquid monetary liabilities. The Chicago Plan proposed making central bank liabilities, bank reserves, the backing assets for 100% of monetary liabilities. The King Plan is far more modest. It presets haircuts for all assets with the requirement that monetary liabilities be consistently less than the post-haircut value against which the central bank is committed to lend. Both have problems. The Chicago Plan effectively makes money a state liability once again. And then the question, of course, among many things, is what is the government to do with the resources that it thereby obtains? The King Plan can, of course, create a usual vicious spiral because haircuts rise in a crisis, leading depositors to realize that the backing is not as solid as they thought. And of course, as Martin has already indicated, these create huge overlapping jurisdiction problems for complex institutions with complex sets of monetary liabilities. This is why we basically insisted on the ring fencing in Britain, the ring fencing of domestic retail banks. So these are also imperfect solutions. Will either or any of these radical proposals be adopted? No. Basically, the political economy of today's banking involves the creation of an open-ended subsidy to bankers, and the latter are extremely effective in justifying that subsidy. Every time there is a big crisis, there is going to be somewhat more regulation, but these regulations will be eroded because, after all, as the bankers always say, this time is different. So I agree with the analysis. I've discussed an alternative approach, which has some, I think, interesting features that's not superior, but the crucial point is the game is so lucrative and the analysis that the bankers put forward is so widely accepted that it is almost impossible for me to imagine that we'll break out of the Red Queen's race. And that's what I have to say.
Thank you, Martin. Martin Hellwig, would you share this quite skeptical interpretation or forecast of what might happen and what the possibilities, the opportunities of really changing the system are? You're muted.
I share the assessment, but before I explain why, let me make one comment. Martin, I don't think it's just the supply of liquid assets that makes the banks so powerful. I think the fact that they are available to the political system as a source of funds also plays a key role. You were mentioning the word racket, and I think that's really part of it. And the interesting thing is that we've seen bailouts of many institutions that were neither in the deposit business nor in the lending business, just because, well, they seem to be financially important. Now, to answer your question, Thomas, I think the major cost of the 2008 bailouts, in particular by comparison to the 1921 and 29 to 33 non-bailouts was that their success in stabilizing the financial system and the economy allowed bankers to continue as if nothing had happened. They did not lose credibility in public debate. And as of 2009, already you had Mr. Ackerman speaking for the International Institute of Finance, shouting out against further regulation. The cause for, quote, or any reason for quote unquote optimism might come from having a real crisis where bailouts don't work, which actually is not entirely unlikely, because some of these institutions, think of UBS, think of JP Morgan Chase, have dimensions where even the taxpayers might find it difficult to solve the problem. In making these considerations, I've often said an avoidance of the consequences of the Great Depression was worth it. As a German, of course, I'm very much aware of what the consequences of the 1931 German crisis were. If I look at the world today, I'm not so sure that we have been successful in avoiding such consequences. Make it very blunt. I think the resurgence of war as a standard state of activities also has at least some sources in the events of 2008.
Okay, Martin, would you agree? You're muted.
One of the things I most enjoyed, if enjoyment is quite the right verb, in our discussion last year on my book, is that I found that Martin was the only discussant of my book in anything that I've read or heard, and I've done quite a few discussions, who thought I was too optimistic. So that's one of the pleasures of talking with Martin, is I find I'm a cheery optimist. I think that I suppose there are two sorts of questions here. The first is, what would have happened if we'd done something differently in the past? I have to say that as of now, and this might prove a terrible mistake, I think that what happened in the Great Depression was a bigger policy mistake than what happened after 2008. I was pretty sure at the time, I wrote a great many columns about it after 2008, that broadly what was being done had to be done, and that the alternatives of adopting, and some people did recommend it, not, it has to be said, very many, of choosing to let much of the banking system collapse were really unthinkable. It is perfectly true that the political aftermath of 2008 has been, this really gets to my second point, has been pretty bad. And in my book, which we were discussing a year ago, I argue that the financial crisis itself was an important, possibly the most important, but certainly an important reason for the loss of confidence of the public in the people in charge of our system. But the conclusion I drew from that is that the best solution is to regulate banks and banking institutions in ways that reduce this vulnerability very significantly. And I agree with Martin, and it was always plausible that if we emerged from the crisis successfully and did not change regulations sufficiently to reduce very substantially the fragility in this system, that there was a risk of further crises. And at the limit, it's quite clear there can be a crisis in which the states get overwhelmed. Namely, it is one in which the run on the banks and the rescue, followed by a rescue by the state, which is then followed by a run on the state. And runs on the state can happen perfectly well. You basically, nobody can be persuaded to hold government liabilities. And you're going to live in a society like that, though you would need there will be a great deal of coercion on the way. So there's clearly a risk that failing to regulate leads to that outcome. Now, the difficulty now, I have to agree, is we can now see 15 years later, that we are on a path that almost inevitably is likely to make the next crisis bigger. It seems to me reasonably plausible that will be, partly because the fiscal position of states is likely to be significantly weaker when it occurs. And second, because we have a large number of institutions of colossal scale which do have these sorts of incentives. Now, this doesn't mean that every banker is going to misbehave in this way, but some are. And if some bankers behave in this way, they affect the incentives for everybody else, even if they really want to behave properly, because they're going to lead to some pretty dangerous mispricing in credit markets, which sound banks can only respond to by shrinking, and they don't like doing that. And that's part of the story. As the famous remark of the head of Citi, Chuck Prince, said, well, as long as everybody's dancing, we have to keep dancing. So there is a real danger that because we failed fundamentally to transform the incentives in the system, the next crisis will be worse and could possibly be truly unmanageable. But I have to say, maybe that's my short-sightedness. I still would not have said in 2008, the right thing to do is let most of the major banks in the world fail.
The question then would be if the bankers would still say this time was different.
They will always say that. And the politicians don't want to change the incentives for the reasons we've discussed. And I agree with Martin's additional point. Of course, there are a whole range of ways in which banks are influential and bankers are influential. And breaking the link between the banking system, broadly defined, the financial system, and the state is incredibly difficult. To me, it is the core Achilles heel. I hate the misused metaphor. It is the Achilles heel of the capitalist economy.
I just wanted to say, I mean, if you're right in this, that the crisis will be bigger, at some point the lack of proper reforms and so is linked to the fact that everyone feels like, well, in the end we can handle this. And if at some point this will not be the case, maybe that will provoke more thoughts or on the political side. But that's speculation on the crisis.
Can I respond
Yes.
on 2008? In terms of economics, I think you're quite right, and I said the same at the time. The negative side effect that we didn't see was that this didn't make the bankers lose. This way, the bankers didn't lose enough legitimacy. Now, the Obama administration, when it came in, could have done something about that. If the Obama administration had taken the stance of the Democrats in 34, 35, and gone after the banks rather than prioritizing healthcare, lots of things might have developed differently. The fact that they didn't go after the banks was in part a problem or a consequence of the fact that too many people who have been involved with the system were parts of the administration, and in part a consequence of the fact that the president himself didn't want to be so confrontational. Roosevelt was confrontational and had different election results afterwards. So in terms of the politics, meaning also the radicalization of populist politics, that failure had lasting effects, which we are still feeling today.
Okay, there's one question from the participants, Andre Kuhlens, and then two questions from in the FA Q&A. Andre.
Sorry, I don't have a question. Sorry, it was a mistake.
You don't have a question. Okay.
Sorry, yeah, sorry.
You raised your hand. Okay, there are two questions. The last one was Simon Guntrum. I will read it quickly, and I think it's quite a good question. What role do you ascribe to central banks in possible future financial crisis or banking crisis, never-ending liquidity backstops that may, to some extent, fuel another round of high risk-taking? What should be the optimal approach for central banks? We had this discussion some weeks ago in a very interesting discussion between Bundesbank head Joachim Nagel and Moritz Schularik. I mean, they didn't find the absolute solution, but at least a Bundesbank president admitted that this is a legitimate question. So maybe you can give an answer to this question.
I think the question is ill-posed. It should be, is there a trade-off between bank regulation and good growth?
Okay, you have the first, I read the second one, and you answered the first question. But it's okay. That was the first one. We can go this way around. The first one was on, is there a trade-off between banking regulation and growth? Yeah, that's the one. Go ahead.
Fine, I can talk about central banks. The question repeats the warning we have in the chapter on bailouts and central banks. Basically, if central banks can be expected to provide liquidity, then they take risks that make this need, that make this support necessary. I mean, this is what we saw in March 2020. It's what we've seen in other liquidity crises. The knowledge that there is someone with a backstop makes people careless about the risks that they're taking. The way the system works now, central banks step in whenever there seems to be a panic coming up. I don't actually think that that needs to be bad, but it needs to be accompanied by proper regulation. And I have not seen much of that. The 2020 regulation, I'm sorry, the 2020 interventions did not have any very serious implications for what financial institutions were allowed to do, meaning what kinds of contracts they could write. It's taken for granted that central banks will step in. One thing that has changed for liquidity management is that commercial banks or rather deposit-taking institutions, hold many of their reserves with the central bank, much of the liquidity with the central bank. Before 2008, they relied on money markets for liquidity, and the freeze of money markets in September 2008 was a major part of the story of that month. So why do they hold reserves? Because reserves pay interest. That's, of course, Milton Friedman, the optimum quantity of money. It doesn't cost society anything to increase the real quantity of money in the system. Mind you, I'm not talking about inflationary effects. Just give people an incentive to hold this stuff. And it's clear that having liquidity based on reserves is less of a threat to financial stability than reliance on money markets. However, there is a fiscal side to this. I mean, Milton Friedman's analysis was carried out on the assumption that there was a lump sum tax to fund any deficit. We don't have lump sum taxes to fund any deficit. Right now, central banks are making losses, not so much because the securities they've purchased are so bad, but because the interest they pay on deposits have gone up. And here we're talking about substantial amounts of money, which is basically a redistribution from taxpayers to the banking sector. We need to, there one needs to ask whether the benefit that Milton Friedman asserted is worth that kind of cost.
Martin, would you?
Yeah, I mean,
want
we get into. I have just two comments on this. The central banks are part of the state, and in crises anyway, and more generally, what they do in this area is part of state functioning. The regulators of the banks may or may not be in the central banks, but that's clearly a state function. So one has to see it as the state's relationship with these core financial institutions. As the system operates today, the state is inextricably engaged in it all, but it's mainly a tacit partner, except in crises. But the point is, it is the risk bearer of last resort, and as part of that, it's also the intervener of last resort. And I have this line, which is sort of a joke, that you basically have to regard banks and bankers as part of the state, and that just makes bankers the most highly paid civil servants we have. This is only partly a joke. It's just not possible to view them as independent because so much of the risk taking is ultimately underpinned by the state. On the reserves issue, this is then gets into public finance in a different way. Now, you could say that we are imposing reserve requirements on banks because that's a way of making them safer and offsetting their natural incentive to run themselves in such a way that is likely to lead to liquidity crises. And we could say, well, we could impose a reserve requirement, which we consider to be what it makes the banks behave safely. That is to say, they have adequate reserves. I won't go into the problem of how they're created. And we're not going to recoup, we're not going to pay them for holding these reserves. And it's a tax because it should be. We're trying to tax them. And then we would only pay reserves, pay interest on excess reserves. Now that would get above these mandated requirements. I'm not wildly keen on that, but I can see the logic. And I certainly can't see any huge logic for giving banks a very large freebie from the holding of reserves, as we're doing now. It's not a risk-taking activity of banks. There isn't any risk from their point of view in lending to their own government. So why should we reward it in this way? But this starts getting into more technical questions. But the key point I would make is that central banks are part of this system. We created it for a very long time. We thought we were following the Bailout rule, which is that the central bank would lend money at a discount, and that's why I went back to the Mervyn King proposals, in a way that would clearly be costly for them. And as a result, they knew that was going to be imposed on them and they would be more cautious. That is clearly out the window. That's not the way things operate now.
Okay. Martin, I interrupted you. Would you ask or re-ask the right question on when you said on banking regulation and growth? You started to say that this is not the right question.
Okay, first of all, badly designed regulation will hinder growth. Secondly, not all growth is good. Think of the wonderful growth we saw in the years before 2008. Much of that lending was wasted. And the houses that were funded with that lending came to rot. The next observation, if we think about innovations, bankers are typically not in the business of financing innovators. Even when bankers have venture capital subsidiaries, those venture capital subsidiaries tend to be more cautious than the venture capital companies that act on their own. You might say that contradicts the notions that bankers take risks at the public expense. But think about the trade-off. If you have a wonderful new trading strategy for complicated derivatives, you can move huge sums in minutes. That's much easier. And the risk-taking can have a much more attractive upside than if you do venture capital finance, where you actually have to work through what are these guys doing and to supervise what they're doing. That requires people. People are expensive. Empirically, it's not clear that banks are so very much involved in funding innovation. One has different institutions serve that purpose. And one reason for why, say, the US have had so much more spectacular successes in that development has been that those institutions work better in the US than in Europe, where there are governance issues and tax issues and traditions that work against them.
Thank you, Martin. Martin, last word on this question, otherwise.
I'm inclined to agree. If you look at the balance sheets of very, very large financial institutions, it's pretty obvious they're not going to get a large amount of money out of doing the immensely hard work of finding new, exciting, innovative businesses that will make the future. That's just not where large amounts of money are invested. But that doesn't mean they don't take risks. So if you have financial institutions, this is my last thing, who do have, I did this for Britain, so I don't know where it's true, but I worked out, this is about 15 years ago at the time of the crisis, an enormous proportion, I think about 80% of bank lending was essentially property related lending. Essentially, they were speculating on the property cycle. They didn't think they were, but they were. Now, we rescued them because we didn't allow the property cycle to collapse as it would otherwise have done. Comes back to our discussion of 1931 and so forth. But that was what they were doing. And it was clearly, they might have thought it was perfectly safe. It was all backed by bricks and mortar, but it all depended on the price of property. And similarly, when they lend vast amounts of money to governments and government debt at near zero rates, they're again taking a huge sectoral risk. So one shouldn't assume that the risky things they're doing on the asset side, I mean, leaving aside the liability side and all the rest of it, are necessarily the exciting sort of risky things you would want them to do to promote growth. They're essentially taking huge speculative positions on very, very broad asset classes.
Thank you. I think we're at the end. We're coming to the end. I just would want to take the question, or take over the question of being optimistic or not optimistic. This has nothing to do with this question, but anyway, I think it's quite fascinating to see if you look into what's happening in Germany. 1 year ago, and that's not about banking, but about fiscal policy. 1 year ago, if you had asked anyone in Germany or around if there will ever be a discussion about reforming the debt brake, you would have never found anyone to say, and everyone would have said that's excluded in Germany. It will never happen. Then something happened that nobody expected, that the Karlsruhe ruling questioned what the government has done, which went in the other direction, which then has opened up the discussion. And now we have a very lively discussion about how to reform the debt brake. We are not yet there, but this may be an example of how paradigm shifts are sometimes happening, and sometimes you don't expect, and then something happens. Nothing about banking. I mean, that wouldn't apply directly to this, but maybe. And that would be the optimistic version. And maybe, I don't know if I can say, hopefully, Martin, it won't be necessary in 10 years to again add 4 chapters and 50% of the volume to explain why again nothing has happened, and again we are in a more difficult position. Hopefully not. I mean, hopefully things will get better, and hopefully your book will be read by a lot of people. I'm showing this too. I don't know if you can see. Your one was better. I don't know exactly. So yes, yeah, fine. You don't have this this fog around you. Princeton University Press, and yeah. So have a good day. We will continue next time, early May, 2nd of May, with a discussion on and around Bidenomics and why Americans are not happy with Biden, despite all the economic positive things that are going around. This will be a shortcut with Catherine Kremer. And also this will be going towards our big summit end of May on and around how to win back the people, which is also about populism, Bidenomics, and so on. Less about banking, but that will be at the margin too. So have a good afternoon in your Martin Wolf, somewhere in the UK. And last word, just you warned us that you're outside and on land side in the UK, and maybe there will be problems for the Zoom meeting. In Germany, we recognize that apparently in the UK there's no problem with that, which is not the case for us. Very often we have these problems. Martin, Hellwig, many thanks for presenting, and again, let's have another discussion, hopefully more optimistic on all this soon. Thanks both.
Thank you very much.
Thank you, pleasure.